Good afternoon, everyone, and welcome to Prestige Wealth Management Group's fourth quarter 2024 economic and financial markets update. On today's webcast, you're going to hear from Prestige's Senior Portfolio Manager, Paul Esposito, Director of Financial Planning, Jeffrey Spivak, and Wealth Advisor, John D'Angelo, and myself, Wealth Advisor, Michael Williams. Just a couple of housekeeping items before we get started. This webcast is being recorded, so be on the lookout. We will send out a recording afterwards. But we are not able to take any live questions during today's webcast. But if you do have any questions, please feel free to email us at pwm@prestigewmg.com, and we'll be sure to get back to you. So just on the agenda today, we're going to talk through the state of the U.S. economy, the inflation in the Fed, equity and fixed income markets, and some financial planning considerations for 2025. So let's get started. So just to jump in, talking about the state of the economy, for GDP in the fourth quarter, they reported a 2.7% growth rate, which, again, we maintained the momentum coming out of the Q3. As you can see in the chart, there's two line items there. There's the blue chip consensus and the GDP now. GDP now is kind of based off of some more current data points that kind of lead to kind of what the estimate is for what GDP is. Based off that, where the consensus is on a little more of a lag basis. But for 2025, the estimates are still coming in pretty strong, around 2 to 2.5%, generally between the consensus. But again, the big takeaway here is the economy and kind of the U.S. economy in general. People have been predicting this recession that's been coming for the last couple of years, and lo and behold, the economy has remained strong, right? And there's a couple, factors that have been, kind of leading to that. One of the big ones that we're going to talk about in the second is just kind of the strength of the consumer, right? So the consumer spending is actually the largest driver of the U.S. economy, accounting for about 70% of GDP, actually accounting for the GDP in the country. And again, all of this is leading to kind of that consensus that the Fed is trying to shoot for, which is kind of a soft landing scenario. We're not 100% there yet, but all things considered, the economy has held up extremely well given the circumstances of, higher inflation rates, higher interest rates, et cetera, et cetera. So going into the LEI, the leading economic indicators, as you can see, those kind of bottom out starting in 2023, and actually the leading economic indicators have shown some strength as well. So those have turned around. On the right-hand side chart, you're going to see kind of the data for the manufacturing and non-manufacturing index. The dark blue line, you'll see the manufacturing index kind of, both of them took a bit of a decline, but as you can see for the manufacturing actually showed its first expansion in 8 months, which is a positive sign. But more importantly, the services sector, or the non-manufacturing index, is still in growth territory, and about 77% of the U.S. economy is service-based, which is really important. And again, the economic indicators have showed broad-based strength, and a lot of the things that are contributing to this resilience is actually in the labor market. So again, the fact that when people want to get jobs, they can find jobs, also leads to them, kind of supporting the consumer spending, which kind of leads to helping keeping the economy going at a good pace. But on the unemployment front, unemployment came in around 4.1% in Q4, which is up from the historic lows of 2023, but right at that full employment level that the Fed is shooting for. And again, it supports consumer spending and growth. Actually, the employment picture has actually led to a little bit more volatility in the markets, whereas kind of the markets are contending with these two factors, meaning the economy kind of holding up and doing well, but also not kind of things going so well that for the Federal Reserve doesn't feel the need to cut interest rates. One of the more recent examples of that was the non-farm payroll recently came in at $256,000 for the or dollars, 256,000 jobs for the month versus the estimates of 155, which on the face of it, you would think would be a positive thing and the markets would go ripping higher, but actually markets went downwards because that would lessen the likelihood of the Federal Reserve cutting interest rates going into next year. Now, Paul's going to talk about in a little more detail the Fed and interest rates, but just a data point there. So going into business and consumer confidence, again, things are looking pretty positive there. So in the fourth quarter, small business CapEx plans actually expanded by 15%, which is kind of on the very right-hand side of that first chart on the left. You see a giant spike upwards. And again, there's no exact kind of correlation between why that spiked upwards, but some things that we do believe are kind of contributing to that is, one, regardless of the outcome of the presidential election, just the fact that there's certainty about who the president is going to be and kind of what those potential policies are going to look like can lead kind of business leaders to a point where they're willing to kind of put their CapEx plans on the table. But again, some of the big things that are kind of on the table that I think we're going to talk a little bit later about is potential for some deregulation going forward, and also the extension of the 2017 Tax Cuts and Jobs Act, which is much more likely now that President Trump is in office, where those are set to expire in 2026 if nothing is done. But now that he is in office, the chances are he's going to try to look to extend those. On the right-hand side, you can see the retail sales and kind of those have grown about 3.5% in Q4. But again, just the big takeaway here is employment stability is supporting consumer spending, which is helping to keep the economy moving forward and afloat. And then finally, on the consumer credit side, this is a key area that a lot of people have kind of been looking at, and something that if you see some of the headlines, there's a lot of a lot of clicks get put out there for people keying on the record credit card debt of 1.2 trillion. There's a couple things you got to consider when you're looking at that number. One being is you do want to make sure you're inflation adjusting those numbers, right? So just the cost of everyday goods has gone up a decent bit just due to inflation. So just because the credit card balances have gone up, it doesn't mean that it's directly like, people should be concerned about the state of the consumer and the household debt. As you can see on the left-hand side, the debt service ratio, even though it is rising, it is nowhere near where it was at, come 2008 or even in the pre-pandemic era. We're still yet to reach those levels. But a couple things on the consumer side that I think that are actually positive is, although the current interest rate environment for mortgages and those sorts of things is difficult, and again, I have nothing but empathy for any first-time home buyers who are trying to go out there and buy the first home, because the interest rates are challenging in a lot of ways. But for existing homeowners, people who have already bought their home, around 60% of mortgages are locked in below 4%. So if you're in an environment where interest rates are rising and your biggest expense from your mortgage and the interest rate perspective is locked in at below 4%, higher interest rates is not necessarily a terrible thing, right? So if you have some cash in the bank, you're going to get a higher interest rate on that, whereas the interest rate you locked in your mortgage at is not going to change. So we don't see a tremendous amount of concern here on the consumer side, but it is something to watch just to make sure that those trends don't get to a point where it's, kind of really worrisome. But right now, we're not seeing anything that's kind of raising any red flags. So Paul's going to take the reins here to talk a little bit about global inflation.
Thank you very much, Michael. Good afternoon, everyone. When we look at the U.S. and the developed market world, they've certainly made a very nice improvement over the past 18 months with regard to inflation, especially when we look at the 2021 peak of both developed markets and emerging markets in general. I mean, we were at the precipice of 8.5% annualized year-over-year growth. That's sort of the crescendo of CPI here within the United States, and in some instances it was much worse for parts of the developing market or emerging market world. So I mean, at least the trend right now is in the right direction for let's call it the United States, the UK, and greater Europe, with regard to it being just slightly above the 2% trajectory. The emerging markets, on the other hand, are not faring as well. I think a lot of that has to do with a strong dollar. We're still continuing to export inflation via a strong dollar to those emerging market countries. The cost of their debt becomes amplified, not only with higher current interest rates, but with a negative Forex translation. When the US dollar appreciates by 10% against the euro or the renminbi, it certainly makes, cost of trade for those counterparts more expensive. Albeit, maybe with the exception of China, which is still in a trend of stagnation. Now, I think most of that has to do with the economic decline that China has been in for quite some time. When we look at the U.S., the run rate of CPI for the fourth quarter into the end of the year, it started off very nicely. We were, running at 2.4% annualized starting in September, but then it managed to climb by the end of December to 2.9% with the December reading. So that, in essence, is really what gave the Fed pause in their December meeting with regard to readjusting their rate trajectory for 2025. Now, we look at the U.S., Japan, and the U.K., have also seen some signs of inflation, a similar trajectory. A lot of that is due to the uptick in consumer spending that we've seen as of late. And some of it is also attributed to a higher labor market, should I say a tighter labor market. But also, something else to consider, when we look at inflation forecasts throughout let's just take the developed market world, for the most part, you're in the 2 to 2.5% range. Yet, if we look at central bank policy is running at a much higher rate than those, obviously to continue to quell inflation. The old saying is that the cure for inflation is higher interest rates, and that certainly holds true for the most part. But when interest rates are staying a lot higher for longer, that ends up having a negative feedback loop. So, part of it, is somewhat, self-inflicted, interestingly enough, until the Fed and other central banks, are more comfortable with what the run rate of inflation is, and they can start to adjust rates accordingly. So if we look at the parts of inflation, again, if we look at, the June 2022 peak of, 9.1% CPI reading, we're all the way down. I know this chart's a little dated with November's reading being at 2.7. As I said earlier, we're at 2.9. But the breakdown is fairly similar. Shelter costs have remained a stable contributor of inflation. Housing prices continue to remain, a sore spot for the Fed. Rents have also picked up slightly. The weakness seen in consumer discretionary spending in 2023 and 2024 has certainly affected core goods prices. If you notice the orange at the bottom, so that's actually detracted from the rate of inflation. Obviously, in the post-pandemic, run-up when there were supply chain issues, that contribution exploded significantly higher. But that has certainly helped curb inflation by, a few tenths of a percent with CPI. The same is said for energy prices, which is in green. On a year-over-year basis, energy prices have certainly have fallen, even though, we have seen, at least an initial uptick. Then again, today, crude prices are falling. And let's just take into account the backdrop. This is with continued tensions with Russia and Ukraine, continued tensions in the Middle East with Gaza. And, now you have an administration that certainly wants to be, more pro oil and gas production domestically. And from what I understand, and President Trump's recent Davos speech wants to compel the Saudis to increase their output to, further curb global oil costs. That could certainly be a very nice tailwind for, inflation overall. If we kind of delve a little bit deeper into some of the metrics that we're watching inflation-wise, first chart, the upper left hand, it talks about the manufacturing prices. And within that survey, you'll see that the dark blue line for manufacturing is right on the precipice of contraction, or has been. Even going back to 2022, it was in a contractionary environment. And again, a lot of that had to do with, the consumer-led, you want to call it a consumer-led recession in spending over that time period. So, for the first time in 2 years, we're again starting to see it in that expansionary region, which certainly indicates that, we could start to see a little bit more in the way of inflation contributing on that end. If we look at the lower left-hand chart, you're also going to notice that rents, from the peak, the 2021-2022 peak, have come down considerably and are certainly more normalized. So that's certainly a positive sign. And then looking at the charts on the right-hand side, to start at the top chart, wage growth. Wage growth has come down since the post-pandemic peak. It still resides at about 4.5%. I think the Fed is really looking for that to sort of revert to pre-pandemic range, which is something closer to inflation. A 3.5% to 4% range would certainly bring them more comfort. I certainly think we're a ways away from that, and that could very well stay much higher for longer due to the labor force shrinking as a result of many baby boomers starting to retire. And then looking at small business prices, that's another trend that we're keen on. We've recently started to see an uptick in small business plans for increasing prices. Obviously, going back to from 2020 trough, there was a drastic increase in the years following. Again, mostly due to supply chain constraints. And things certainly have normalized, maybe not quite to the range that the Fed is looking for, but very well close to it. So, when we look at, the market's love-hate relationship with the Fed, and let's just reference the December 18th, 19th meeting, which certainly spooked markets. Before that Fed meeting, they were slated to cut rates by a full 1% in 2025. However, Fed Chair Powell, along with a few other Fed members, became concerned that the Trump administration's new policies with regard to tariffs and immigration would contribute to a higher run rate of inflation, and that gave caution to the rate expectations. So that, in conjunction with the gradual move higher in CPI numbers, was enough to give the Fed a concern to consider a much slower path in cutting rates in the upcoming year. And really what this chart is showing is what the Fed funds future expectations are in the coming year. You're seeing all the different meetings, the percentage probability of a hike or a cut. They're all in the cut territory. But if you follow the blue line all the way to the end of 2025, the last meeting, 12/10, the market right now is only pricing in 1.5 cuts. And, the market would certainly like to see more, because that would certainly help with credit. Businesses love seeing that as well. That allows them, to enjoy cheaper costs of capital. But pausing rate cuts is not necessarily a bad thing. I think markets have demonstrated their resilience in the wake of higher rates. and a slow rate cutting or even a pause rate cut period has historically been good for both the equity markets and the economy, especially if you go back to the mid-90s, even the early 2000s. Those were very stable rate periods, and the equity markets and the economy did certainly enjoy excellent periods of growth within those timeframes. So trade and immigration are I think, on the minds of many investors. And I realize that the proposed policy outline for the new administration on these topics is going to have a lot of investors worried about the impact that they'll have on input prices, inflation, GDP growth. But we have to look at with regard to at least tariffs, because I know the current president has certainly postured a lot recently toward tackling fair trade. So if we look at our key trading partners, Mexico, China, and Canada, they currently account for 41% of total trade with the U.S. Import-wise, we're importing 1.4 trillion of goods. Export-wise, we're exporting about 850 billion. So the notion of a trade war is certainly concerning to businesses that have supply chains that are heavily integrated with regard to global trade. And if you expand that trade with our top 15 trade partners, so to extend it, it would be those three plus Germany, Japan, Korea, Taiwan, Vietnam, the UK, India, Netherlands, Ireland, Italy, France, Brazil. Now we're talking about 75% of our total trade. The implications of a 20% tariff, either selectively on industry, could certainly have higher cost implications. Since the U.S. is a net importer, the implications for tariffs on balance in the near term would certainly be inflationary, and that's something that we're continuing to figure out. Once the policies become better outlined, what effects they will or won't have on the market. Even if the intention is for certain industries to be onshored in the U.S., it's not as easy to move production operations from one country to the U.S. overnight. So the effects of inflation very well could be much longer lasting. But undoubtedly, we need to see definitively what plans the Trump administration has with regard to using tariffs to broker trade agreements with our key partners, the size of those tariffs, the extent to which they'll be applied on certain industries will give us a better semblance of how production costs will be affected. Sorry, I skipped ahead here. The administration, again, has also been focusing on handling policies regarding illegal immigration, which may indirectly impact the labor force as well. So if you look at the chart to the right, it's showing the growth in the labor force relevant to real GDP growth. And you can see, the light blue line is labor force, dark blue line is real GDP, that there is a correlation between the two. Again, it's too early for us to tell what curbs will be placed on U.S. immigration in general and what impact mass deportations will have on both the skilled and unskilled labor pools. Hopefully, the administration is being mindful that a decline in the labor force can also lead to a lower GDP output, as represented by that chart. But again, it's a little too early for us to really make assertions about what we don't know. I guess this is more of a history lesson on tariffs. So if we look at the duties that are being proposed underneath the current administration, something close to 20%. Again, we don't know how broad-reaching those duties are going to be, what industries, what sectors they're going to target. But if we put that into relation of the early 30s, it was the 1930 Smoot-Hawley Tariff Act, which placed tariffs, the duty was between 20 to 40% on over 20,000 imported goods, many of which were critical to the day-to-day function of the U.S. economy. It was an act that was created, post-Depression as really a protectionist accord designed to help the U.S. economy, maintain economic productivity internally during the Great Depression. Unfortunately, it ended up having the opposite effect and worsened trade by 67% during that time. Now, I think trying to make, the analogy that what's being slated is going to be comparable to, a Smoot-Hawley tariff accord, again, I don't think that's a really fair assessment of the situation. As evidenced by President Trump's first term, the effective duty on imports ended being far less than what was first proposed, and was only applied to specific industries and not to all trades. So I think that certainly needs to be taken into consideration. Now, many would say that the most recent 10% tariff threat to China to curb fentanyl trafficking is something that we should be very, very worried about. Well, the U.S. economy could probably afford to weather a 10% blanketed tariff with all trading partners when it comes to imports. And as I alluded to earlier, the U.S. dollar since September has strengthened by over about 10% with our trading partners' currencies in aggregate. So input costs would virtually be unaffected should we engage in a 10% tariff with China or other trade partners. And quite frankly, this is most likely the reason why equity markets have paid little attention to the headlines. And so I'm going to take a pause for now, and John D'Angelo is going to discuss the equity market overview.
Thanks, Paul. Let's dive in and talk a little bit about the stock market and about equities in general. Let me start by reiterating a little bit about what Mike was alluding to earlier when we were talking about the general economy. And let's talk a little bit about the investment backdrop, because I'll start with the positives. And the positives are the investment backdrop is constructive for markets, which is why markets probably have been rising over the course of the last couple of months. So we can start with what Mike talked about prior. The tax, the 2017 tax cuts remaining in place. So one, the backdrop for taxes is going to remain low, but there's also certainty. There was uncertainty going into the election around what the tax policy would be, and there was some fear that there'd be less investment in the United States without knowing what the cost structure would be. So that's a positive. Lower regulations mean lower costs for businesses. It means higher profits. It's also a positive. And although Paul discussed, the December Fed meeting being a little bit more hawkish, the bias is still at interest rates should be, at least the overnight lending rate should be falling in 2025. So the investment backdrop is fundamentally positive. So let's move into talking a little bit about what concerns us, when we look at the stock market. And the chart that you're looking at, is probably number one. our concern, which is valuations. Valuations are a bit high. This has been a conversation that we've been having, I'd say probably for close to a year. When we look at this chart, we're looking at forward multiples of about 21.5 times, call it 22 times earnings, where historical fair value of the stock market is probably more along the lines of 16 times earnings. So we do have some concerns about the market being a little bit expensive. You could even see, from some of the historics, we're looking at either, right before the tech wreck, the PE ratio was a little bit higher than it is today, but 25 times earnings. At 21.5 times earnings, I would say the threat or the probability of some type of a price correction during the course of the year in 2025 is probably more likely than not, since we haven't seen one in 2+ years at this point. Let's move on and talk a little bit about earnings, and I'll dovetail this a little bit with, when we look at the earnings growth, and we do have strong expected earnings growth, and this goes back to talking again about artificial intelligence, talking about robotics and machine learning, and the expected growth path there, which is also probably why we're seeing a little bit of a stretch when we look at valuations, because if we look at the Magnificent Seven, those 7 big securities that represent a very big portion of the S&P 500 index, a good many of those are heavily involved in in artificial intelligence, and some of that future growth path is coming from that subset of securities for sure. Now we can move to talking a little bit now about growth versus value, and I think the timing of this slide is very, very good, because we just completed some rebalancing trades for some of our clients. Once again, just like last year, growth had a fantastic year, back-to-back years as far as return is concerned. Growth stocks probably up north of 35% in 2024. We definitely took another measured, what I'll call profit-taking event, where we moved some money from growth into value, as well as rebalancing some portfolios back to neutral targets. In this chart, I think that the important thing to look at in this chart is just when we look at the forward multiples, when we look at value versus growth, long-term average of growth stocks being about 21 times earnings. We're trading close or right around 29 times earnings, which is, historically high. Value stocks are certainly a lot closer to their historical averages, and some of that is investor appetite. There's been a lot of money chasing the technology sector. Certainly, a lot of money being invested in those mega cap growth stocks, and in particular some of those companies that are involved in artificial intelligence. Some of that, I think, is justified. I mean, paying a premium, I think, for some of those securities, I think, is justified based on the future growth. But just like anything else, sometimes these securities get ahead of themselves. They need to sometimes reprice. They need to consolidate before they can get on an upward trajectory again. So I think as a general rule, I think we're still constructive. We're still positive about the asset class, with the caveat that we're mindful and watchful of prices, and we're taking action as we took this month to trim some of those profits from what we'll call a fantastic 2-year stretch.
Thank you, John. I think, if we look at both asset classes, not only stocks, but fixed income, I do think, looking at the asset class behavior just within last year, they are becoming more resilient to, a higher interest rate environment. Albeit, there's going to be some shocks here and there, most of them created by the Fed. But, we are starting to see a more normalized pattern, or should I say, sequence of returns, especially when it comes to fixed income. Now, last year in the U.S. bond market, the aggregate bond market returned a little over 1%. At one point, it was returning well over, almost 5% for the year. It was, if you looked at the rate of return pre-December Fed meeting, or I'd say probably closer to September, and it started to trade down in anticipation of, a more hawkish Fed. But, their rhetoric regarding slower rate cuts certainly sent bond prices down. However, if we look at what it's done to long-term yields, it's caused them to move higher, where, starting yields are now close to 5% for the aggregate bond market. And if we look at, other sectors of the bond market, maybe some of the more esoteric components like high yield, convertible bonds, floating rate debt, you're actually getting starting yields that are much higher. So it's certainly providing a more attractive return environment for bond investors. So, this is something that, although, I'd say the last 4 years has certainly been frustrating for bond investors. The last two are at least starting to show a glimmer of hope, with 23 providing a nice rate of return. 2024 not as nice as 23, but we're at least hopeful that things are starting to normalize. So this chart here is really just the migration of the good old yield curve from a 3-month Treasury all the way out to a 30-year Treasury. As you can see, the dark blue line right in the center of the light blue and the light green is showing a 10-year U.S. Treasury rate right around 4.6. I believe we're right in that realm. I think 4.65 today is what the 10-year has recently ticked to. Based on current inflation projections and the Fed's rate cut trajectory for 2025 of 2 cuts, it's our belief that the 10-year is probably going to bounce between the October 2023 peak and the July 2023 peak inversion of the yield curve. If we think about it this way, if the Fed cuts twice and inflation is below estimates, that's more than likely going to send yields lower, where we see a 10-year yield going closer to 4. But if they don't cut and inflation runs hot, our projections are that we'll probably see something closer to 5%. Now, given the fact that we have seen CPI numbers glide upward, the Fed has been, a little bit hesitant on their dot plot, and of course curtailing their rate cut, for 2025. I think that's why we're seeing a 10-year that's closer to 5% than 4% at this point. But if we do see, if the Fed does in fact cut 2 more times this year, we will see short-dated debt, CDs, and money market rates be immediately impacted. I mean, right now, if you look at 3-month Treasuries, all the way out to, say, 2 years, you're still getting some very healthy yields. So fixed income investors certainly may want to consider focusing on the 3 to 7 year part of the yield curve, again, based upon your own personal goals, objectives, and risk tolerance. All that needs to be taken into consideration. But those are probably going to be more sustainable yields over the longer term without exposing oneself to the amount of interest rate risk that you get at the longer part of the yield curve, called the 10, all the way out to 30-year As I alluded to earlier, fixed income yields are certainly very healthy based upon historical norms. When we look at current yields to maturity across both the core and the extended sectors of the bond market, all yields are very compelling. They're well above their 10-year median. But even if we look past, that if we go back to even 20 years, these current yields are right in line with their long-term figures. Granted, the last 10, call it 15 years, we're in a abnormally low interest rate environment, so it's only natural that the current yields are going to be across the board well above those median rates. So for investors that do in fact have fixed income as part of their allocation, taking on call it a core plus approach, including some bond exposure in the esoteric classes such as high yields or convertibles. Again, making sure it's in accordance with your risk tolerance and keeping in line with certain risk parameters could certainly be very compelling from a risk-adjusted standpoint based upon where starting yields are. But actually, our diversified taxable bond portfolio has held convertible bonds and high-yield bonds for most of 2024 and actually continues to do so for the start of 2025. So bond returns in general, if we look at just the last 4 years, as I said earlier, certainly been a very challenging environment for bond investors. But with inflation and interest rates now starting to normalize, we do expect bonds will start to conform more to their long-term mid-single-digit return profile, somewhere in the 4.5% to 5% range is what our expectation is. For the last 4 years, certainly, a roller coaster ride. When we look at 2021, a slightly negative return, and then, of course, in 2022, we had a double-digit loss in the bond market. But 2023 and 2024 have shown, signs of moderation. And if we look at the historical return record of the aggregate bond markets, this goes back the last 44 years. There have been very few negative return sequences experienced, especially back-to-back losses. Now, again, we always have to provide the disclosure. We can't, past performance is not an indication of future returns. But again, from a historical standpoint, I just believe that bonds are actually starting to offer investors attractive risk-adjusted return potential. And the same is very true for real return expectations going forward. If inflation does manage to stay at 2.5%, and bond starting yields, are, let's call it 4.5% to 5.5%, bonds on average are going to have an inflation-beating return of almost 2.5%. So that's, a very nice story, especially if you do have fixed income integrated into your portfolio, a, diversified stock bond allocation, I think will, start to provide better in the way of risk-adjusted performance potential. And so I'm just going to hand things over now to our Director of Financial Planning, Jeffrey Spivak.
Hi, everybody. Good afternoon. Happy New Year to those of you I haven't spoken to. For those I haven't had the opportunity to meet yet, I'm kind of coming up on my first full year here with Prestige and with my fine colleagues that you've heard from already, and to work with many of the clients that are on the phone. During the course of that year, I want to point out that one of the things 2024 really taught us was kind of falls in line with that old commercial, which is a financial plan is valuable. It's really valuable. You can use it to make decisions. You can use it to look forward. You can look and, beat your chest about how well you did based on previous planning. But it's the ongoing, continuing planning that is priceless. That's where the plan comes to life. going in, tweaking it, fine-tuning it, adjusting it based on circumstances. That's the thing that's going to provide the flexibility to be able to maneuver future volatility. So when people ask me what it is that we're focused on, for 2025, when it comes to planning, very simple. Oh, there we go. Very simply, I'm looking to revisit the plan. I'm looking at it here. I want to keep your plan updated, on track. I want to build adequate flexibility against future need. And you may look at that and go, well, I had a plan done a couple of years ago. But realistically, coming back, revisiting is going to find challenges and opportunities we may not have thought about before. We'll take on the onus of helping you to plan for it. But one of the things that I'm going to ask you as our clients to do is think about your goals. Think about what other goals we may not be planning for. I will ask you goals to be quote unquote smart, by which I mean specific, measurable, achievable. We want to make sure that they're relevant, and we want to make sure that they're time bound, because we want to be able to measure the impact on your plan and be able to build for that. So I want to identify any new goals or responsibility or challenges that may have come up, because one of the big lessons I've taken away in the last 12 months here is that an updated plan is going to be our best defense against the emergent unexpected. Part of that plan is going to be a focus on cash flow needs. What are the needs in terms of cash? How do they flow? What are the tax impacts? And one of the things I suggest strongly is being able to track your spending and use it to revisit budgets. Even high and ultra high net worth clients very often find a lot of value in being able to maintain a budget, maintain the sense of that cash flow. We can help you to automate that. If you want us to help you to automate, you just have to let us know. We want to make sure that from a cash flow perspective that you don't get caught off guard or unprepared, that there's an adequate emergency fund established, to be able to focus for 3 to 6 months worth of expenses, and make sure that fund is available and liquid, but still earning conservative, competitive rates. Another big focus that I found in my conversations with clients is being able to align your financial plan against what it was you selected in open enrollment, the benefits that you currently have. This is going to be particularly important if you anticipate either a change of employment. Thank you. Either a change of employment or or your overall employment situation. Sorry, guys. All right. Let's talk about contributions, the taxable, tax-deferred, and tax-free accounts. So one of the things that we've noticed over the past couple of years is balances, particularly within plans, have swelled very, very strongly. Largely, this is the result of good investment results, which is great. But to me, from a planning perspective, the best way to prepare in advance for future volatility is by increasing contributions. Knowing how much we can increase those contributions means getting a good handle on the cash flow to try to determine how much surplus there actually is for us to be able to gather. Those contributions could be to retirement plans, or if you're no longer working, no longer have earned income, it could be to taxable accounts, it could be to other accumulation vehicles. But remember, the more that you purchase, volatility actually adds to the better effect. That is to say, when the stock market's doing well, we tend to buy less shares with that payment. When the stock market is seeing downward drafts, we buy more shares at a cheaper price, which over time is going to serve to help lower cost bases. We also want to focus when we look at these accounts to try to determine, if a Roth contribution or a Roth conversion might actually be of benefit to you. Fidelity recently reported a 45% increase in the number of Roth conversions, as people are planning for and anticipating potentially higher future taxes. We won't necessarily focus in and make a decision whether to do a Roth conversion now based on what's happening macro or even microeconomically. It's really on the basis of what your cash flow looks like, what your marginal tax brackets look like, and being able to pick the window when it makes the most amount of sense. But planning for that can fall very much into the domain of our conversations. This is also a good time for us to talk about asset consolidation. And one of the notions behind it is some of our clients maintain accounts that are on the outside. It doesn't matter if the accounts are on the outside, but being able to look at a holistic asset allocation can really serve your portfolio over the long term. If you want to maintain those accounts, fine, but I would maintain it, under that holistic asset allocation and location alignment. Last but not least, on the focus here, while we're talking about contributions, we also want to talk about opportunities to rationally plan for harvesting of ongoing gains and losses, being able to match those. That we typically do a great job at the end of the year of matching for tax efficiency, but we also want to see what it is that's being done that perhaps isn't in our control and how we can counterbalance that as well.
Way more challenging this year.
Oh, yeah. Yeah. Paul literally came into my office one day, his face long, going, I don't have any losses. I don't have anything to offset against gains. When we look at our accounts tax character, part of the focus is, are we invested too aggressively? Are we invested too conservatively? And what's more, are we invested, with the right risk tolerance or risk objective based on the account's character? Whether it is a taxable account, a tax-deferred account, tax-free, an annuity account. This is what we talk about when we talk about holistic asset location and allocation. Remember that being able to use the tax character of your account effectively, that's going to not impact the returns that you're getting so much as the returns that you get to keep afterwards. Another big focus for me for this year is looking at liabilities, lines of credit, insurance, and risk management. We want to review every element of the balance sheet to try to consolidate debt to improve interest costs. We want to look at extend policies and risk management tools, some of which may be getting old, some of which may be no longer adequate to the actual need, some of which may be completely unnecessary. But we want to look at each of those elements and try to determine how it's going to fit in the overall whole. The last big focus I want to talk about for 2025 has to do with the estate plan. Now, to me, when I look at an estate plan, all estate plans should contain as a minimum a last will and testament, powers of attorney, and healthcare proxies of various types, depending upon your needs. These should be relatively recent. If you haven't revisited them in the past, don't fall into the mistake where you're naming an awful lot of people to have key person or executor privileges that are no longer interested, capable, or, even, able to walk erect, being able to make decisions. We need to make sure that your estate plan is in good shape that way. So we want to focus, make sure that it's clear about your intentions. We want to audit your beneficiaries to make sure that the people who stand to benefit from your accounts when you no longer are able to use them are in good shape to be able to receive them. If you have charitable and philanthropic intent, and many of our clients do, planning for which gifts we're going to gift can also lessen the potential cost of gifting. It can remove future capital gains, and potentially it can lower your estate and inheritance taxes that may one day be owed. Pardon me. So we want to plan on how to best gift to family and friends. We want to determine when and what form the gift is given. As we're going through here, what's going to have that best impact, the optimization for both you as the donor, for the beneficiaries who are going to receive it. Now, one thing I did want to spend just a couple quick minutes on is to talk about areas of uncertainty for 2025. I want to issue a cautious word on the use and reliance about artificial intelligence. Artificial intelligence is something that we've talked about. I think all four of us have talked about it over the course of this call. People are excited and they like it. I just wanted you to be careful when applying it for planning. You know, to me, AI is great, but it's not going to replace good advice and guidance, but it might feel like it's replacing good advice and guidance. As we become more and more accustomed to asking for Siri or Siri's spiritual family tree for answers, be aware that shortening the research time it takes to or expertise doesn't necessarily improve it. An awful lot of the answers that result are something like the best answer you can get for under 5 questions, which isn't necessarily what you want to focus on, but it's relevant. We've seen clients who wind up following deep rabbit holes going completely in the wrong direction. All they really need to do is pick up a telephone and ask their advisor for some guidance. That's one of the reasons that we're here. And don't be surprised if part of that focus, that guidance, is let's update your plan and see what it is that we're looking at. One of the other ones that Michael alluded to is at the end of 2025, we are faced with the possibility of the Tax Cuts and Jobs Act of 2017. Many of those provisions of that tax act expiring. Things that could be changing are larger standard deductions for tax returns might go away, and we might be back in a world in which we're itemizing fairly frequently. So planning for that in advance is going to be important. Why? Because it means going back to the old school, which is maintaining expenses, maintaining receipts, making sure that you're keeping track on things. We could also lose the enhanced child care tax credit, which may be important to you, it may be important to your kids and in reference to grandkids. For those of you who have small business income, that 20% deduction that started in January of 2018 might go away. The SALT cap, the sales and local tax, state and local taxes cap, is also scheduled in, which for some might be good news. But for many clients, the federal and state tax exemptions might move from $13.9 million in 2025 to somewhere between $6 to $7 million in 2026. We don't know right now what the TCJA is going to look like in a year. We know that we've heard commitment from over the course of the election that they're going to try to revive most, if not all, of the TCJA. But what can get passed over the next 10, 12 months, I don't know. But we will communicate and we'll walk down those halls of uncertainty together. Assuming we can identify what opportunities might appear or disappear, once that clarity comes, we will communicate it to you. So my last comments have to do with other considerations here. You know, we talked a lot about uncertainties, and I will tell you this, uncertainties that may impact on our planning, things like climate change, evolving regulatory landscapes, the acceleration of digital transformation, economic changes due to central bank policy shifts, fluctuating consumer spending, geopolitical tensions, emerging markets growth that Paul was talking about. I look at all of this and I say, you know, there's an awful lot of uncertainty there. So what hasn't changed? What hasn't changed is our clients need to plan for their retirement, either in advance or in retirement. What hasn't changed is the need to accumulate wealth, to manage it, preserve it, and ultimately distribute it. So, you know, things to think about as we go in, whether the TCJA expires or is changed dramatically, high net worth investors may want to consider taking advantage of what is right now the highest ever lifetime gift and tax exemption. That opportunity is likely to disappear. We can't know what's going to come, but we do know this. Change is the only certainty. It's necessary, needed, and ultimately it's going to be beneficial. Now, if change is certain, then planning becomes more important than a singular plan you may have done previously. This year is shaping up to be an exciting year. I'm looking forward to working with you all. We're going to look at the challenges and opportunities. We're going to walk down that path together. Thanks, everybody.
All right. And with that, we want to thank you guys for joining us. And just as a reminder, if you do have any questions, please send those in to pwm@prestigewmg.com and be on the lookout for the email we will be sending with a recording of today's webcast if you'd like to revisit any of the topics we discussed today. And with that, we want to thank you guys, and we'll see you next quarter.